A price crashes. Panic spreads across trading floors. Yet behind locked doors, something unusual is happening. Bullion dealers are not celebrating lower prices. They are scrambling. Display cases that should be full are empty. Wholesale suppliers are extending delivery timelines, and the people buying are not amateurs. They are the ones who understand what most cannot see. That when paper burns, metal becomes oxygen. The question is not why silver fell. The question is, why are the informed moving in the opposite direction? And what do they know that the market refuses to price in? Welcome to Cruising Archive, where we document the patterns that shape wealth and the decisions that preserve it. Now, if you have lived long enough to watch markets deceive the majority more than once, if you recognize that wisdom is not found in headlines, but in understanding what happens after they fade, then this channel was built for people like you. Do us the honor. Press that subscribe button. Not because we ask, but because you know the value of being informed before the crowd realizes what happened. And tell us, from which corner of this world are you watching today? Drop your location in the comments. We read every single one. Now, let us proceed to what the silver market is really telling us. On the morning of February 5th, 2025, silver prices experienced a sharp decline that sent ripples through financial markets worldwide. The spot price dropped significantly within hours, triggering automated sell orders and prompting financial media outlets to declare another setback for precious metals investors. Trading desks lit up with red numbers. Analysts prepared their bearish commentary. The narrative seemed clear and predictable. But something else was happening. Something that did not align with the public story being told. While COMEX futures traders were exiting positions and paper silver contracts were being liquidated at an accelerating pace, a completely different phenomenon was unfolding in the physical bullion market. Dealers across North America and Europe reported an unusual surge in buying activity. Not the cautious wait-and-see approach typically observed during price declines, but aggressive, immediate accumulation. Within the first trading hours, multiple bullion retailers documented inventory depletion rates that normally take days or weeks to achieve. Display cases that opened the morning fully stocked were nearly empty by midday. Phone lines were overwhelmed with purchase orders. Online inventory systems showed products moving from available to sold out in real time, faster than staff could update the websites. This creates a fundamental question that demands examination. When an asset's price falls, conventional economic theory suggests demand should decrease. Buyers typically wait for confirmation that the decline has ended before committing capital. This behavioral pattern has been observed across virtually every asset class throughout modern financial history. It is the standard response mechanism, the predictable human reaction to perceived loss. Yet, in this instance, the opposite occurred. The physical silver market experienced what can only be described as a buying frenzy precisely at the moment when price signals suggested retreat. Informed buyers were not waiting for stabilization. They were moving with urgency that suggested a time-sensitive opportunity was being recognized. This divergence between paper market behavior and physical market action represents more than a temporary anomaly. It exposes a critical structural reality that most market participants either do not understand or choose to ignore. There are two silver markets operating simultaneously, and they are increasingly moving in opposite directions. The first market is the paper market, the realm of futures contracts, ETFs, and derivative instruments. This market is vast, liquid, and capable of absorbing enormous capital flows with minimal friction. Price discovery in this market is dominated by algorithmic trading systems, leveraged speculation, and short-term positioning. When Federal Reserve statements alter interest rate expectations, or when technical chart patterns break key support levels, this market reacts with mechanical precision. The second market is the physical market, the world of actual metal that must be mined, refined, transported, and delivered. This market operates under entirely different constraints. Supply is limited by geological reality and production economics. Delivery requires time, logistics, infrastructure, and verified inventory. And most importantly, physical metal cannot be created through leverage or fractional reserve mechanisms. These two markets are connected by price, but increasingly disconnected by availability. When the paper price drops sharply, it should theoretically make physical metal cheaper and more accessible. The retail buyer should find abundant inventory at attractive prices. Dealers should compete for customers by offering discounts and promotions. This is how supply and demand is supposed to function in an efficient market. Instead, what occurred on February 5th was the opposite dynamic. As the paper price fell, physical premiums expanded. Dealers were not offering discounts. They were struggling to maintain inventory. The spread between spot price and retail acquisition cost widened precisely when it should have contracted. This premium expansion during a price decline is not a minor technical detail. It is a signal that informed capital is interpreting market conditions through a completely different analytical framework than the mainstream narrative suggests. Professional bullion dealers, who operate at the intersection of wholesale supply chains and retail demand, witnessed something they recognized from previous periods of monetary stress. The buyers entering their stores were not panicked retail investors dumping assets. They were strategic accumulators, individuals and entities who view price volatility not as risk to be avoided, but as opportunity to be exploited. The question that emerges from this observation is fundamental. What do these buyers understand about the current monetary and economic environment that causes them to move aggressively when others are retreating? The answer to that question requires understanding forces that operate beneath the surface of daily price movements. The official narrative attributed the silver price decline to a single event, a Federal Reserve policy statement released in the early hours of February 5th. Financial media outlets seized upon specific phrases from the announcement, interpreting them as signals of continued monetary tightening or delayed rate cuts. Within minutes, algorithmic trading systems processed the keywords and executed predetermined sell protocols. The cascade began. But here is what the narrative omitted. The Federal Reserve statement contained nothing fundamentally new. No surprise policy shift, no unexpected economic projection, no revelation that altered the underlying trajectory of monetary expansion that has defined the past 15 years. What changed was not policy, but perception. And perception in paper markets is often mistaken for reality. Sophisticated market participants recognize this distinction immediately. While futures traders reacted to the statement's surface language, institutional buyers and wealth preservation strategists were analyzing a completely different data set. They were examining the Federal Reserve's balance sheet, still measured in trillions despite so-called quantitative tightening. They were calculating the mathematical impossibility of servicing national debt levels without continued currency creation. They were observing global central bank gold purchases reaching levels not seen in decades. These are not the actions of institutions confident in fiat currency stability. The divergence between official policy statements and actual monetary behavior has widened to a point where the two exist in almost separate realities. Central banks speak of inflation control and fiscal responsibility, while simultaneously maintaining policies that guarantee continued currency debasement. This contradiction is not lost on those who understand monetary history. Consider the mechanism at work. When the Federal Reserve announces a policy stance that markets interpret as hawkish, paper assets tied to interest rate expectations react accordingly. Precious metals. Futures, contracts, which trade on leverage and short-term sentiment, experience selling pressure. This is the mechanical response, predictable and swift. But physical metal operates under different rules entirely. Physical silver cannot be printed into existence when demand surges. It cannot be conjured through monetary policy statements. It exists in finite quantities, extracted from the earth at significant cost, refined through energy-intensive processes, and distributed through supply chains that require time and infrastructure. When informed buyers recognize a disconnect between paper price and underlying monetary reality, they move to convert fiat currency into tangible assets before that disconnect becomes obvious to the broader market. This is not speculation. This is strategic positioning based on historical precedent. In 1979, as the Federal Reserve under Paul Volcker began raising interest rates to combat double-digit inflation, precious metals initially declined on the news. The official narrative suggested that higher rates would strengthen the dollar and reduce demand for inflation hedges. For a brief period, paper markets reflected this interpretation. Then reality intervened. As the true scale of monetary debasement became undeniable, silver prices multiplied nearly tenfold within 18 months. Those who sold during the initial decline based on Federal Reserve statements watched in disbelief as physical metal became increasingly difficult to acquire at any price. The paper market narrative had been wrong, catastrophically wrong. The 2008 financial crisis provided another instructive case study. When Lehman Brothers collapsed and global markets froze, silver prices plummeted in the immediate panic. Futures traders dumped positions to meet margin calls. Financial media declared the end of the precious metals bull market. The narrative was clear. Deflation would destroy commodity values. Yet within months, as central banks unleashed unprecedented monetary expansion, physical silver demand overwhelmed available supply. Dealers could not maintain inventory. Premiums exploded to levels that made spot prices almost irrelevant. The Federal Reserve had responded to crisis exactly as monetary history suggested it would, by creating currency on a scale that made previous expansions look modest. Those who understood this pattern accumulated physical metal during the panic. Those who trusted the official narrative waited for lower prices that never materialized in the physical market. February 5th, 2025 represents another iteration of this recurring pattern. The Federal Reserve statement triggered mechanical selling in paper markets. Algorithms executed their programming. Short-term traders took profits or cut losses. The visible price action suggested weakness and further decline ahead. This is what most market participants saw and what kept them on the sidelines. But beneath this surface activity, a different class of buyer was acting on a different set of assumptions. They were assuming that regardless of Federal Reserve rhetoric, The fundamental trajectory of monetary policy remains unchanged. They were assuming that debt levels have reached a point where any deviation from currency creation would trigger systemic instability. They were assuming that official inflation metrics vastly understate the true rate of purchasing power erosion. And they were assuming that when this reality becomes undeniable to the broader public, physical precious metals will not be available at current premiums, or potentially at any premium. These assumptions are not based on conspiracy theories or internet speculation. They are based on observable data, historical precedent, and the mathematical realities of sovereign debt dynamics. The informed buyers emptying dealer inventories are not gambling on short-term price movements. They are positioning for a monetary environment where the distinction between paper claims and physical assets becomes the defining characteristic of wealth preservation. The Federal Reserve Statement was not the cause of strategic accumulation. It was merely the catalyst that created temporary price dislocation, an opportunity for those who understand the difference between market noise and structural reality. And the window for such opportunities is narrowing. There exists a quiet crisis unfolding in the silver market that receives almost no attention in mainstream financial analysis. It is not dramatic. It does not generate headlines, but it is relentlessly tightening the available supply of physical metal in ways that cannot be reversed through monetary policy or market sentiment. Silver is disappearing permanently. Unlike gold, which is primarily accumulated and held in vaults where it remains available for future transactions, silver is consumed. Industrial applications destroy the metal's recoverable form. Solar panels absorb silver into photovoltaic cells that will not be economically recycled for decades. Electronic components embed microscopic quantities of silver that are dispersed beyond practical recovery. Medical applications utilize silver's antimicrobial properties in ways that render the metal unrecoverable. Every year, billions of ounces vanish into products that will never return to the supply chain. This is not temporary demand. This is permanent removal from available inventory. The scale of this consumption is accelerating at a rate that few market observers have fully internalized. Global solar panel production alone now consumes more silver annually than the entire jewelry and silverware industries combined. As nations pursue renewable energy mandates and carbon reduction targets, this consumption is not slowing. It is projected to double within the next 5 years. Electric vehicle production adds another layer of structural demand. Modern vehicles contain significantly more silver than their combustion engine predecessors. Charging infrastructure requires silver in electrical contacts and circuit boards. The transition to electric transportation is not a temporary trend subject to reversal. It represents a permanent shift in industrial demand patterns. Medical technology has discovered applications for silver that were not economically viable a decade ago. Antimicrobial wound dressings, surgical instruments, water purification systems, and even certain pharmaceutical compounds now incorporate silver as an essential component. Healthcare demand grows in direct correlation with global population and medical advancement, both trending upward on trajectories measured in decades, not market cycles. Meanwhile, primary silver mine production faces constraints that cannot be solved through price increases alone. Approximately 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply is largely inelastic to silver price movements. When copper demand weakens due to economic slowdowns, silver production decreases regardless of silver's price. Mining companies cannot simply produce more silver in response to market signals because they are primarily mining for other metals. The remaining 30% that comes from primary silver mines faces its own set of limitations. Ore grades have been declining for decades. The easy deposits have been exhausted. New discoveries are rare and typically located in geographically challenging or politically unstable regions. The capital investment required to bring a new silver mine into production now exceeds $1 billion in many cases and requires 7 to 10 years from discovery to first production. This supply constraint is not theoretical. It is geological reality. Several major silver-producing regions are experiencing production declines that cannot be reversed through increased investment. Mexico, the world's largest silver producer, has seen output from its largest mines plateau or decline. Peru faces similar challenges. Even exploration budgets have contracted as mining companies focus capital on more profitable base metal projects. The result is a supply-demand equation that has shifted into structural deficit. Industry analysts who track physical flows rather than paper contracts have documented consecutive years where industrial consumption and investment demand exceeded new mine production plus recycling. This deficit has been filled by drawing down above-ground inventories, stockpiles that were accumulated over previous decades when supply exceeded demand. Those inventories are not infinite. They are being depleted at an accelerating rate. Exchange-traded funds that claim to hold physical silver have seen consistent outflows as investors redeem shares and take delivery of actual metal. This represents a transfer from pooled, liquid holdings into private hands where the metal becomes effectively removed from available supply. Once an investor takes physical possession, the metal typically does not return to the market unless prices reach levels that justify liquidation, levels far above current trading ranges. Sovereign mints report unprecedented demand for silver coins and bars. Production capacity has been expanded multiple times, yet mints still struggle to keep pace with orders. Delivery times that were once measured in days now extend to weeks or months. This is not speculation driving demand. This is individuals and institutions converting currency into tangible assets as a deliberate wealth preservation strategy. The Bullion dealer network provides the most immediate indicator of supply tightness. These businesses operate on thin margins and rapid inventory turnover. They do not benefit from holding excess inventory in a volatile market. Yet dealers across multiple continents report difficulty sourcing product from wholesale suppliers. Premiums charged over spot price have expanded to levels that would normally indicate temporary supply disruptions. Except the disruptions are no longer temporary. When dealers cannot restock inventory at reasonable premiums, it signals constraint at the primary distribution level. When wholesale suppliers extend delivery timelines, it indicates tightness further up the supply chain. When refineries report backlogs, it means the physical metal is not readily available even at the source. This is the environment into which the February 5th price decline occurred. Informed buyers recognize that a lower paper price combined with tightening physical supply creates a rare asymmetry, the opportunity to acquire tangible assets at temporarily suppressed prices while structural deficits continue to drain available inventory. This is not a gambling opportunity. This is strategic positioning based on supply-demand fundamentals that operate independently of short-term price volatility. The industrial consumers of silver, the solar manufacturers, electronics producers, and automotive companies that cannot simply stop using silver if prices rise. They have no viable substitutes for many applications. They must acquire the metal regardless of cost. This inelastic demand provides a floor beneath the physical market that paper trading cannot penetrate, and every ounce that disappears into industrial use is an ounce that will never return to satisfy future demand. The buyers emptying dealer shelves understand this reality. They recognize that supply constraints combined with permanent consumption create conditions where physical availability becomes more valuable than price optimization. Better to acquire metal at a slightly higher premium today than to face unavailability at any price tomorrow. The mathematics of depletion are unforgiving and accelerating. Every monetary system in human history has ultimately rested on a single fragile foundation: confidence. Not gold reserves, not economic output, not military power, but the collective belief that the currency will maintain its purchasing power into the future. When that confidence erodes, the transition from stable monetary order to chaos can occur with stunning velocity. The events of February 5th, 2025 provide a lens through which to examine where confidence currently resides and where it is quietly evacuating. The paper-silver market demonstrated confidence in Federal Reserve narratives and central bank credibility. Traders sold based on policy statements and technical chart patterns. They trusted that the system would function as it always has. The prices would eventually stabilize, that liquidity would remain available, that paper claims would be honored. This confidence is not irrational. It has been rewarded for decades. The system has absorbed numerous shocks and continued operating. But the physical silver market told a different story entirely. The buyers who emptied dealer inventories were demonstrating a fundamental lack of confidence, not in silver, but in the long-term viability of fiat currency systems operating under current debt trajectories. They were acting on the assumption that at some point the gap between official promises and mathematical reality becomes too wide to sustain. They were positioning for an environment where the distinction between owning a claim on metal and possessing actual metal becomes the critical variable in wealth preservation. This is not pessimism. This is risk assessment based on historical precedent. Consider the scenario framework that strategic capital allocators are currently evaluating. In the best-case scenario, central banks manage to maintain confidence while continuing monetary expansion at rates sufficient to service sovereign debt obligations. Inflation remains elevated, but controlled within ranges the public will tolerate. Currency debasement proceeds gradually, uncomfortable but not catastrophic. In this environment, precious metals appreciate steadily as insurance against purchasing power erosion. The base-case scenario assumes less favorable conditions. Fiscal deficits widen beyond what can be financed through conventional debt markets. Central banks are forced to choose between allowing interest rates to rise to levels that would trigger sovereign defaults, or expanding currency creation beyond what can be disguised through official inflation metrics. Capital begins rotating out of paper assets into tangibles at an accelerating pace. Premiums on physical precious metals expand significantly as the gap between paper claims and available inventory becomes obvious to a broader audience. The stress scenario is one that few wish to contemplate, but that monetary history suggests is not impossible. Confidence in major fiat currencies breaks down rapidly as populations recognize that purchasing power is being systematically destroyed. Flight to tangible assets overwhelms available supply. Paper claims on precious metals are revealed to be backed by far less physical inventory than believed. Delivery failures occur in futures markets. The price of physical metal becomes effectively undiscoverable as transactions occur outside official exchanges at premiums that bear little relationship to spot quotations. Each of these scenarios has historical precedent. They are not theoretical constructs. The Weimar Republic, Zimbabwe, Venezuela, Argentina. The pattern repeats with variations, but the core dynamic remains consistent. When governments finance expenditures through currency creation rather than productive economic activity, the outcome is mathematically determined. The only variables are timing and velocity. Informed capital allocators are not predicting which scenario will unfold. They are positioning for the range of possible outcomes by holding assets that maintain value regardless of which path the monetary system takes. Physical precious metals represent one of the few asset classes that performs this function across all three scenarios. The premium expansion observed in physical markets during the February 5th price decline provides a critical signal about market structure. When paper prices fall but physical becomes harder to acquire at any premium, it indicates a growing disconnect between price discovery mechanisms and actual supply-demand fundamentals. This disconnect has historically preceded periods where paper markets cease to reflect physical market realities. The professional bullion dealers who maintain substantial inventories through volatile periods are making a strategic calculation. They recognize that temporary price weakness creates acquisition opportunities, but only if physical metal remains available. Their willingness to buy during paper market declines signals their assessment that current prices represent value relative to long-term monetary trends. This dealer behavior deserves attention because these businesses operate with complete information about both wholesale supply conditions and retail demand patterns. They see orders from sovereign mints. They communicate with refineries about production schedules. They track premium structures across global markets. When dealers are aggressively buying rather than liquidating inventory during price declines, it indicates their forward assessment favors physical metal scarcity over currency stability. The portfolio construction implications are significant for those managing substantial wealth. Traditional allocation models typically suggest single-digit percentage allocations to precious metals as portfolio insurance. These models were developed during periods when monetary stability could be reasonably assumed. They reflect an environment where the primary risks to wealth were market volatility and economic cycles, not currency system viability. Current conditions may require reevaluation of these assumptions. Family offices and institutional investors with multi-generational time horizons are increasingly treating precious metals not as speculative assets, but as core monetary holdings. Allocations in the 15 to 25% range are no longer considered extreme among wealth managers who prioritize preservation over growth. The logic is straightforward. In environments where currency purchasing power is being systematically eroded, holding claims denominated in that currency represents guaranteed loss of real wealth. The liquidity consideration that often discourages larger precious metal allocations becomes less relevant when the alternative is holding assets whose liquidity depends on maintaining confidence in institutions that are mathematically insolvent. Physical metal may require time to liquidate, but it cannot be defaulted upon, it cannot be inflated away, and it cannot be confiscated through monetary policy. The critical insight that separates strategic positioning from speculation is understanding the difference between price and value during monetary transitions. Price is determined by marginal transactions in liquid markets, by the most recent trade between a willing buyer and willing seller. Value is determined by what an asset will preserve or purchase in real terms over extended time horizons. During stable monetary periods, price and value converge. During monetary transitions, they can diverge dramatically. The buyers who emptied dealer shelves on February 5th were not concerned with whether silver would trade higher or lower in the subsequent weeks. They were securing a tangible asset with 4,000 years of monetary history at a temporarily suppressed price. They were converting fiat currency, which exists as electronic entries in fractional reserve banking systems, into physical metal that exists independently of institutional promises. This is the behavior of capital that has made a fundamental assessment about the trajectory of monetary systems operating under current debt burdens. The urgency implicit in their actions should not be dismissed as irrational panic. It represents calculated positioning by those who recognize that windows of opportunity to convert paper wealth into tangible assets close rapidly once the broader public reaches similar conclusions. History demonstrates that by the time monetary crises become obvious to mainstream observers, physical precious metals are no longer available at any reasonable premium, if available at all. The silver market is sending a signal. The question is whether decision makers are positioned to interpret it correctly, or whether they will recognize its significance only after the opportunity to act has passed.